Good evening. Something strange is happening in the financial markets that the mainstream media is not covering. A 20-year pattern has just shattered. Central banks are making unprecedented moves, and a $1.2 trillion annual expense now threatens the entire system. So, what connects these seemingly unrelated events? And why are major institutions quietly repositioning their assets? Well, our guest tonight has spotted these patterns before. Colin Plume returns to connect the dots between mysterious market signals, April 2nd's looming announcement, and what major financial players are doing behind the scenes. Now, the last time these indicators aligned, it changed the fortunes of those who saw it coming and devastated those who didn't. So the question isn't whether major shifts are coming, but who will be prepared when it arrives. Colin Plume, welcome back to the show.
Gary, always a pleasure. Excited to be here.
Yes. Now let's talk. Right before we went on, you said gold just broke 3,000.
Yeah, absolutely. Yeah, it's breaking new highs. Gold's up 50% over the last year and a half. So all those people that were saying, "Oh, it doesn't pay a dividend, it doesn't do this, it does," they're sadly missed out on some pretty massive gains.
Well, even people I see sometimes in the comments, they're like, "Well, why would I want to invest when gold is so high?" Well, guess what? It's keep going up, right?
Yeah. I mean, they don't say that about Nvidia. They don't say
No.
that about a lot of stocks. They don't say it when the stock market's at an all-time high, even though we're in a recession right now. I mean, the indicators are a recession where we're at right
Wow.
now. So I think it's hard because things feel expensive because you look at the price, but then you don't look at everything else that's gone up in price, and everything else has gone up significantly in price. But I look at the central banks. Central banks, last 3 years in a row, over 1,000 tons of gold they've been buying consistently 3 years in a row. It's never happened in history. They actually, before 3 years ago, central banks had never bought more than 1,000 tons. And we're talking about not the U.S., obviously, because we're broke, but the rest of the world has been buying cumulative over 1,000 tons of gold for 3 years in a row. So you have the biggest net buyers, not net sellers, net buyers buying, putting it in their coffers, and hoarding gold for the long term. So it's not a surprise that this is happening.
Okay, so now we're talking with Colin Plume of Noble Gold Investments. He's going to tell us about silver because it's finally broken above the crucial $32 to $33 resistance zone after a 2-decade-long pattern. You've called this go time for silver.
Yeah.
So why is this potentially a life-changing moment for investors?
Yeah, well, right now there's one thing you have to look at, and it's a conversation. It's a bigger conversation, but there's a few different scenarios you can look at. The number one scenario would be the silver to copper ratio. And if you go back the last 5 years, silver and copper typically move about 70% of the time together. So they have about a 70% likelihood of them moving together. Over the last year, it's at 88% likelihood. Copper is on fire right now. Silver started to move. It's starting to catch up. But 88% of the time, they move together when you look at the chart. So this $32, $33, $34 resistance level is a really important level as copper starting to move, silver's moving together. You see the charts kind of moving, starting aligning up, and you're seeing this curve in this right direction. So it's an exciting time for both really important industrial metals. And that's a big part of why we've seen this movement in silver start to happen.
Okay, so the gold to silver ratio is at 88. It's significantly above the historical average, 53. So if this ratio just reverted to normal, what price do you think silver would hit, and what could send it even higher?
So that's funny because it's exactly the same price in my book. Silver is a new oil that I predict. It hits $58. Okay, so that's the number that I predicted for my book. So if it hits a normal, the 53 ounces to 1 ounce of gold ratio, then we're sitting at silver at about $58, which is what I predicted. So my book came out in December last year. I predicted by the end of 2026, we'd be at a $58 level, which will be broken through its all-time high of 50, and I believe that it's going to hit those numbers. And really, if you look at the charts of the usage, if you look at a pie chart of usage, right now we're at about 42% as industrial uses, um, solar, EV, all these uses that are happening and growing, refrigerators, all this stuff that's happening. They predict that amount of industrial use for silver is going to go up by almost 50% over the next 10 years. So that number of usage in silver is going to grow in terms of just the silver that's in the world, and the industrial use is going to go up. That doesn't even factor in jewelry. It doesn't even factor in investor demand like coins and bars. We're just talking about using it in industry. So that's why I think a lot of people are thinking these ratios are going to happen. And for people who are like, oh, it's never going to hit that 53-to-1 ratio, gold to silver ratio. In 2011, silver was at about a 30-to-1 ratio. So, and we're sitting at 88 today. So
I remember we were minting our own silver coins back then.
I'm sorry?
We were minting our own silver coins back then. So I remember very clearly when silver was just going way up.
Yeah, no, I went on a massive run, and a part of it is, we're seeing that is the industrial use is really growing relative to the other uses. And I still think even in terms of jewelry, with gold being so expensive, I think we're going to see more of a push into silver for people day to day. There will be a point that gold for a ring, when gold's at $8,000 and $10,000 an ounce, it's going to become very difficult for a lot of people to afford that. But even if silver's sitting at 120, 130, 140, it still makes sense for jewelry. So I expect that demand to continue to rise also. So it's an exciting time for silver.
Okay, so going back to gold, over 3,000 an ounce. What's driving the surge? You mentioned all these central banks are buying tons and tons of gold, and major banks are now targeting 3,500 an ounce. I mean, that's what they're projecting.
Yeah. Well, part of it is you're looking at part of the demand right now is actually coming from pensions in the gold market. And what a lot of people are not realizing, there's a massive CLO bubble, commercial lending, CLOs, commercial lending, forgot what the O is, but it'll come in. But basically, it's commercial debt that's happened over the last 10 years. And a lot of this commercial debt, you've seen corporations like Joann's, Spirit Airlines, all of these massive corporations going out of business. And the reason that they're going out of business, collateralized loan obligation, is CLO. The reason that we're seeing a lot of these massive corporations come in and go out of business is because private equity has come in to these businesses like Joann's and a lot of these corporations. They've gone in and they've refinanced their debt with interest-only debt. And they've done that over the last 10 years. And Gary, as you can imagine, if you put interest-only debt in the last 5 to 7 years at 3%, now we're sitting at 6, 7, 8%. So a lot of that CLO debt is coming due. And that's actually why Joann's went out of business. Joann's was a very strong business. If you look at the numbers, 97% of their stores were actually profitable. And so what's really happening, the undercurrent is private equity goes in, they make an offer to the owners. They try to find ways to make quick money because private equity is really raising money from pensions and other places. And they went in and they stripped these amazing businesses into nothing. And now all this debt's coming due, and Joann's is going out of business. Red Lobster's going out of business. Spirit Airlines. There's 100 companies that have been bankrupt by private equity over the last year. And that's really skyrocketing because they're going into businesses and try to make quick profits, pull all the money out. It's greed. The owners are greed. And what ends up happening is you go out of business. Joann's goes out of business. It's a very good business. All the employees are left. They're gone. They don't have jobs. So all like these great kind of Main Street retail jobs are all going to the wayside because private equity came in and screwed up these really old school kind of businesses.
Unbelievable. Now, Colin, let's talk about that global silver deficit for the fifth consecutive year. 182 million ounces in 2024 alone. Mm-hmm. Okay. Paper to physical ratio 378 to 1. What happens if even a small percentage of paper holders demand delivery?
It's impossible. They would never be able to do it. And we saw it in the LBMA. We saw over the last 2-3 months where the London Exchange, people got nervous with the tariffs and they said, we want our gold shipped to the United States. And these people had contracts in gold that they thought was ounce for ounce, right? Well, what ended up happening is the London Exchange ended up eventually saying, we don't have all the gold. We can't ship more gold. And so people were like, what do you mean you don't have the gold? We have a contract for gold that's supposed to be sitting in the London Exchange. Well, guess what? It wasn't sitting in the London Exchange, which proves that these institutions have never been able to keep up ounce for ounce, even though the idea is that you're buying one for one. Same thing with silver, SLV, all of these ETFs that supposedly have it. If they people start calling in these contracts to get physical delivery, they're going to find out that there's not enough silver. It's proven out there. And so these are the scary things that are happening as we're starting to do the transparency era of Doge. People are starting to see, like, wait a minute, like all these things aren't there. That's why they're talking about, auditing Fort Knox and all these things that are happening. They want to know what actually we own. And physical owners of metals are getting very nervous. And it doesn't make sense to me to own a contract of gold or silver right now. The prices of coins and bars are the lowest that we've seen in many years. Even though the price of gold and silver have gone up, the relative to the spot price, these items are very inexpensive right now. And so if you could just own the real thing and avoid the contract or avoid the middle person, you get away from all that risk, because ultimately you're buying gold and silver to avoid risk. So why would you want to get into more risk by having a contract or an
Yeah.
IOU? I mean, how many
Yeah,
items
it's ridiculous. I
have?
mean, it's like fiat. It's like fiat. Federal Reserve prints money. You got a paper contract. There's
Correct.
nothing really behind it. You bring up Doge. We're talking with Colin Plume, Noble Gold Investments. If you want to find out more, go to nextnewsgold.com. It's linked below. Um, you bring up the Doge, and it's one of my favorite topics to always talk about. And you mentioned Fort Knox. What was your reaction when you heard that Elon and Trump wanted to audit Fort Knox?
I mean, it's about time. And I think everybody wants to know why they haven't done the audit. Also, we need to revalue the gold we own, right? They valued it at $44 back in 1974. Today, the spot price of gold is over 3,000. We should revalue it and put it on our books at this higher price. It doesn't make sense to show it on our books at $44. It doesn't add any value to us. Also, I think the public wants to know, hey, how many ounces do we actually own? Because they have sold ounces of gold in our history. We had in 1941, we had 20,000 ounces. And then they did an audit in 1974, we had 8,144. There's no record of them selling. Yet the next audit, we had a lot less. The government just sold. So who's to say they didn't sell from 1974 to today? I mean, it seems logical that everybody wants to know what we have. Ultimately, I think as people that we own that this is ours, right? We own it because we're Americans. We need to know it. So my question is why it hasn't happened as of yet? There was a lot of talk about it, and then I haven't. It's been crickets since then. So
Well, I've been at the White House quite frequently lately, and in fact, I actually sent the question in to the press office, and I was in the press. I've been in several press briefings there, and that was one of my specific questions I wanted to ask, whether it was Caroline Levitt, the press secretary, or Trump himself, when he was departing from Marine One, is to find out, like, what's the status of the audit of Fort Knox. And I have yet to ask that question because it has been quiet, and I want to get some answers. I know the American people want answers, and they especially want to get answers on this. The federal government is spending 1.2 trillion dollars annually on interest.
right.
So at what point does this mathematically break? I mean, Elon Musk is there with the Doge boys, and they're working, and they say, "Listen, this is an unsustainable trajectory." So,
Yes.
how are precious metals historically positioned during these types of crises?
Yeah. Well, I think that you look at the early '80s when inflation was double digits. Gold and silver went up historically very quickly. I think ultimately what it comes down to is why central banks are buying it, why these pensions are buying it, is that they're concerned about not having assets that don't have any debt. I mean, everything has debt. when I was talking about private equity stripping these incredible American companies apart, really private equity, all they're doing is just going in and placing debt on the companies and then just selling off whatever they can and just making as much quick profit. The banks make profit. And then what a lot of times they're doing with these CLOs is they sell these collateralized loans to pensions. And so these pensions are holding a lot of this debt, similar to what they were holding in 2008. It's the same idea, except it's bigger. The CDO in 2008 market was like 1.7 trillion. The CLO market is like 3.8 trillion. So there's a big amount of bubble debt that institutions, and these are pensions that are like regular people that unions that have pensions are buying this stuff. So I think that's why we've seen typical people in the bond market or people that would buy like these safety investments are buying gold because they just look at it as simple math. If gold, listen, I'm not saying gold's going to go up, 30-40% like it has the last few years, but if inflation's at 3% and it seems to be there, right? It's not going anywhere anytime soon. Where can I make a return, above that I feel comfortable with, that I feel safe with, that has, actual value? They can buy more bonds, or they can buy some of this collateralized loan debt out there, or gold and silver as an option. So I think it's just become more of a staple as a part of their portfolio. And so you just see these large buyers just buying gold. And I think the interesting thing that's happening is that now with the LBMA happening and the exposure of the paper market, they're not wanting to buy the ETF, or they actually want to buy real gold and silver. And and we've been getting calls from family offices and people that would typically just buy the stock version, and they're like, we don't trust the stock version. We want to store with you guys in Texas, and we wanted to be able to go there and see it and do all that stuff, which is great. It's fine. I'm happy to do it. But there's a big change. Like, people just don't trust anymore. They want to actually own something physical. They want to know that we don't have any debt, which we don't, and they want to know they're buying an asset that doesn't have debt. And I think that's a big reason why we've seen an uptick.
We're talking with Colin Plume of Noble Gold Investments. He's a sponsor of the Next News Network, and we're happy to have him here, keeping the show going. If you want to find out more, go to nextnewsgold.com. It's linked down below. So, Colin, central banks have been aggressively accumulating gold. You touched on this earlier in the interview, since 2016. So, what is it that they know that the general public doesn't know? I mean, these are the global banksters here.
Yeah, I mean, I think part of it is like you said earlier, is that when everyone else thinks things are expensive, they see the value of it. Also, for central banks, it makes a lot of sense to own gold in that you can barter against gold. So let's say they have a trade between two countries and they want to trade oil, for instance. They can use their gold in different places of the world as collateral, or they could even use it in the purchase of that. When you look at bartering or trading instruments in the world, so many banks, BRIC countries, all of them are getting away from the US dollar. They're afraid of our bubble. They're afraid of that 1.4, $1.3 trillion in interest payments that we're paying. So they're getting away from our US Treasury bonds, and they're diving into things. We have this bubble, and it's not just us. Like, the whole world is living on this unbelievable amount of debt. So I think what it is that it's a duck and cover strategy right now. They're looking to just get into some safe assets. And then I think that with Trump's plan for the next few years, it is a high growth strategy. It's a bold, aggressive, high growth strategy. When you have a high growth strategy, you're typically going to have high inflation in an economy. There's no two ways about it. Tariffs in the short term, I mean, all these things eventually will bring money back into the country, but in the short term, inflation is the byproduct of a lot of these things, and we're going to be affected because a lot of these government jobs are jobs that look good. Our unemployments look good for 2-3 years before at 3.7%, but we know that almost 35% of those were government jobs, where we're getting rid of a lot of those. So unemployment's going to go up. So all the typical indicators that we would say that would be negative are going up. Now, in the grand scheme of things, if we're reducing government's waste, spending, jobs, it's better. Even if unemployment's at 4.5%, but we're not covering the cost of wasted government jobs, it's better. But a lot of these typical indicators are going to look worse, I think, in the next 2 years. And then I think we'll have a full circle moment where inflation will slow down, things will look better, corporations will look stronger. But you can't fix. I mean, Musk did it with X. He fired what 50% of the staff. Like
Yeah.
it's going to look bad
Yeah.
initially. You're going to have problems initially, but in the end, I think that the things will correct themselves. They'll be better. But in the next 1 to 2 years, it's like, well, where do you go? What do you invest into? How do you protect yourself? And so that's why, a lot of people are moving money out of the equity markets. You've even seen, big investors, Warren Buffett, Jamie Dimon, all these guys selling, just sitting in cash. These are people that want high returns, but they just feel unsure about the equity markets here in the U.S. So I think it's going to be bumpy here for the
Oh
next year.
boy. Now you mentioned indicators. Major institutions like BlackRock, Fidelity, they are positioning in alternative assets alongside traditional investments. Do you think this is strategic for a financial restructuring of the system?
Yeah, I mean they're going to buy, um, they're going to buy precious metals. They're going to buy, they're going to pick up a lot of this commercial property out there. A lot of the BlackRock and these guys are going to pick up a lot of. There's going to be a lot of opportunities the next 2 years, and that's why ultimately, as an investment, when you're looking at things, Gary, I always say that you're going to have some stuff that has debt. You're going to have some real estate that's going to have some debt behind it. You're going to have maybe some stocks, but you got to have some stuff that's liquid, like gold and silver, no debt. So if there's opportunities, I mean, we've had people last 6 months that, hey, I found out something I need to buy. I got to sell that gold and silver. I'm up. I doubled my money in the last 4 years with you guys. Great. I'm sure they'd love to stay in gold, but they found an opportunity. You got to have liquidity. And I think that's the key right now for any investors. You got to have liquid assets for opportunities. And I think there will be a lot of opportunities. But yeah, I mean, BlackRock, Fidelity, all these guys, I mean, they're going into safety stuff right now, and they're just waiting until things fall apart. We're going to see a number of banks go out of business here. 100% that's going
Oh
to
boy.
happen. We're going to see a lot of properties come back. I think at the end of this year, they will have to do some kind of commercial bailout
Oh no.
because it's inevitable that there's
No,
just going to be
really.
too many properties out there. They're going to have to do something because if the banks don't want them, where do they go? They're going to go to the government. I mean, where are they going to end up? Someone's going to end up with all these buildings that nobody wants. There's a lot of San Francisco and some of these cities were 40, 50, 60% vacancy. So, these things are going to happen this year, and we're going to see a shakeout. But I think that's the key: is like you hit that bottom and then you pick back up. And I think
Sure.
near the end of Trump's term, I think things will be picking back up. I think GDP will be back up. I think a lot of things will be good.
By the
But
end of the term?
I think in the last 2 years, it's going to be better for him. I think the
Sure.
next year and a half is going to be it's going to be, the economy is going to be, there's no way around. If he's going, this is the like break everything strategy. And I agree
Yeah.
with it. I
Yeah.
think we needed this. This is the
Yeah.
strategy we needed. I think we needed this more
Yeah.
than anything. We
Mhm.
have to shake things up. We have to 1.4 trillion. How do you fix 1.4 trillion? That's what he got it laid in his lap. I mean, how do you fix
Yeah.
it? Right? You can't do things the same way. You can't keep all the government jobs. You got to
Yeah.
shake it up. Sell some of the buildings. Sell a lot of them. Look, he's trying to sell all the buildings. Let's find out how much gold we have. Let's find out what assets we have. Let's see how we grow this country. Let's get the GDP up. But listen, the Atlanta Fed said that they expect growth this year to be 1.7%, which is 130 basis points lower than most of the other Fed predictions. So we're in for some dark times right now. There's no way around it. You can't break things up like this and just have it be easy. But the faster you do it, the faster we can get back up. And I've done it in my career. I've done it with businesses. I've done it. You shake things up. You let people go. You restructure. I mean, that's what he's doing, right?
Well, what do they say? If you want to have an omelet, you got to break a few eggs, right?
100%. You
Yeah.
got it. It's the only way to do it. And listen, he's got Musk there. He's had unbelievable success, right? And he's doing it the right way. They're going line by line. We don't need this. Cut this. What's this job? Come back to work. I mean, these are all the things that you have to do to shake up this economy. And we need to shake up the mindset, right? I mean, part of it is this just kind of laissez-faire, like the government is okay. Well, they'll just figure it out. All these contractors that there's a reason why the majority of the wealth is in this country, and this contractors all in Washington and Virginia, just people that are just milking the government in different ways. So I think it's quite exciting. Listen, it's scary to some extent. There's a lot of people that are nervous about it. I've seen these reports that people aren't going to want to do government jobs now because they're firing. And I'm thinking to myself, like, they're just sending a message that if you're going to do that job, do the job and try to be good at it, and try to grow and try to add initiatives that make sense. Like, it's not, you don't just go into the government job to just have a paycheck. Like, if you're going to go there and do that work, and it's great work, there's a lot of people that we need to do that you should add value, and you should show up for work. I mean,
Yeah.
these are not, I don't think
It's not rocket science, right? Even though Elon Musk is behind it, fixing it all.
Yeah,
Let's talk about the SEC, because they plan to centralize all FICC trading by 25, 26. So how might this trigger the type of leverage purge that contributed to regional bank failures in 2023? I mean, you just mentioned banks are going to collapse.
Yeah, I mean, it's going to put a strain on banks. It's definitely going to put a strain on trading. But these are all things that I think that we need to do. There's also some loopholes with private equity that Trump's trying to get rid of. There's some tax advantages with private equity that he's trying to get rid of, that he ran his campaign on. There's a lot of these measures out there that, and we know private equity, if you look at it as a whole in today's environment, maybe 20, 30 years ago, we needed it, innovation, new ideas, restructuring businesses. But in today's environment with AI and all the technology, private equity coming in is not really doing anything different than what a business owner can do today. You can get all of the access to all that intelligence and all those resources and all that research. You can do all that today. 20, 30 years ago, it was a way to implement money, inject new ideas. We don't need it anymore. So there's a lot of these things happening with banks, private equity banks, that I think need to change, so that companies like Joann's and Michael's and Red Lobster and a lot of these institutions, they were running fine. They were running. They needed some changes, some tweaks, but to go and strip them, put debt behind them, we see what happens. You put these companies out of business, and what it ends up doing is it puts a lot of people that are living off these jobs out of business. And it's, these are brands, the Container Store. I mean, the list goes on and on. These are staple businesses in our country that have driven revenue and added value, and private equities come in and really screw them up. So, yeah, I think there's a lot of changes that are going to happen.
Let's talk about the tariffs. He just signed an executive order. April 2nd is when it's all going to go down, significantly impacting markets globally.
Yeah.
He even said just yesterday, 25% tariffs on any nation that does oil business, or any third party that does oil business with Venezuela.
Yeah.
I mean, that's just one. So how should precious metals investors, like people watching right now, position themselves ahead of this? And how will it affect gold?
Well, I mean, look at Mexico, for instance. We get 80% of our silver from Mexico. There's tariff. It's not excluded. It's part of it. There's other metals that we buy from other parts of the world that we need that are going to have tariffs behind it. There's a lot of things that will happen over the next few months with these tariffs that are going to make some of the things that we need, more expensive. Coupled with the fact that, you have to look at it as there's reciprocal tariffs obviously happening all over the world too. So, how does that affect our prices? Ultimately, if things continue the way they're going, the dollar has lost value over the last 2 to 3 months. In some ways, that may be positive, because that makes our exports a little bit more desirable for the rest of the world if the dollar continues to lose value. So I think everybody looks at the tariffs as one thing, but the big picture between the tariffs and DOGE that they're trying to accomplish is that you want to bring manufacturing here. You want to bring down the cost eventually of things here down to a low level. And ultimately, I think the biggest picture thing he's trying to do is eventually his biggest thing he's trying to do is get that CPI down. He wants to get it. If he gets the CPI down, the 10-year treasury will come down. The 10-year treasury is what our 30-year mortgage is tied to. So if he can get the CPI down, and Powell can do 1 or 2 cuts by like third or fourth quarter of this year, and we can get rates down a little bit, and we can get home 30-year mortgages, let's say in the high fours, it'll change the game. He'll get real estate moving again. He'll get that whole engine moving again. There's a lot of money there. There's a lot of demand. There's home opportunities. People want to buy homes. They can't afford it. He's got to get those things down. So there's some liquidity there and there's some movement there for residential, for commercial, for commercial loans. So I think the big picture is that if you can get our expenses down, gets our inflation down a little bit, it'll be better in the long term. But in the short term, I am concerned about the cost of goods. Things are going to go.
Okay, so what early warning signs should our viewers watch for that could signal that we're moving from a controlled restructuring to potential market panic?
I think what you have to look at is a few things. Consumer sentiment is one thing, and it came out very negative about 2 weeks ago. I would keep a really close eye on consumer sentiment. When you have consumer sentiment, if it continues in that trend where consumers are just not comfortable, there's even CEO sentiment. The CEO sentiment right now is very, very bearish. I would watch those two things. Consumer sentiment is also leads to buying and transactions and how things are going to go. People feel comfortable spending money. If we can see that consistently month after month, consumer sentiment down, then I think we're definitely trading in recession territory. And also I'd be concerned about a recession. Those are the two things that I think we'll have problems with. Now, that being said, a recession is only 2 quarters of data. Ultimately, in my opinion, if we do it fast and quick, then maybe things could turn around at some point in a year or two. But I think this consumer sentiment data is a telltale sign. In my opinion, we're already in recession. So I think it's already happening. We're starting to see it a little bit in the stock market, but I think it's going to get worse over this year. I think it's going to get worse before it gets better, in my opinion.
All right, we're talking with Colin Plume of Noble Gold Investments. Tap the link down below, nextnewsgold.com. And you can get in touch with Colin and his team if you have any questions regarding the points that Colin brought up today. Colin, thank you so much for sharing these crucial insights at such a pivotal moment for precious metals and our nation.
Thanks, Gary. Always good to be on.
Absolutely. Now, the signals couldn't be clearer. With gold setting 15 record highs already this year, silver breaking out of a 2-decade pattern, and global debt reaching mathematical impossibilities, we're witnessing what could really be the early stages of a historic monetary restructuring. Colin Plume has laid it out, a compelling case that connects precious metals performance to the broader challenges facing our financial system. From the unsustainable interest burden to accelerating de-dollarization, these are not isolated events. They're pieces of a puzzle that point towards significant change ahead. So whether silver reaches several $100s per ounce or gold pushes beyond 3,500, the more important takeaway is the preservation and the function of these assets during monetary transitions. So as history has repeatedly shown, those positioned correctly before major system changes protect not just their wealth, but their financial independence. So make sure you contact Colin Plume at Noble Gold Investments, link down below at nextnewsgold.com.